The past month has been a tumultuous time for the US. Just as a strong rebound in activity was confirmed by the September quarter GDP report, new cases of COVID-19 surged once again to fresh highs across the nation. However, the economic uncertainty created by these conflicting forces pales in comparison to that generated by the 2020 election. Instead of the Democratic landslide that the polls predicted, a neck-and-neck contest has emerged in the presidential race, with Joe Biden just ahead. It may be days before the result is considered final, or potentially weeks if legal proceedings are involved. While the uncertainty around the presidential race should prove a short-term issue, a divided Congress will be a lasting concern for the US. If the Democrats hold onto their majority in the House of Representatives and the Republicans the Senate, the entrenched political uncertainty of recent months could extend not only to year-end, but through 2021 and beyond. Most important here is the lasting impediment this division will create to additional, sustained economic stimulus. The immediate need for additional stimulus in the US is very real, despite the strong rebound seen in the September quarter. Though it has essentially halved since its peak, the unemployment rate remains at a historically elevated level, near 8%. Those still on unemployment benefits are rapidly using up their remaining entitlements, and support for businesses from policies such as the Paycheck Protection Plan, which closed to new applications back in August, is quickly fading. Abnormally high initial unemployment claims and slow employment growth signal considerable labour market churn, limiting the ability of those still out of work to easily return to employment. This is without the current resurgence of COVID-19 impacting the economy. The economy escaping another shock from COVID-19 seems increasingly unlikely. Daily new cases of COVID-19 reached a new high a few days before the election, just shy of 100,000, and another 93,000 cases were reported on election day. Even more worrying than the number of cases is their geographic spread. For an outbreak of this scale, effective infection tracing is nigh on impossible, and there is a significant chance of major cities and their health systems once again becoming inundated with cases during winter, forcing local authorities to act harshly. The probable economic cost of the virus's resurgence to activity and confidence is therefore material and likely to get worse. These realities considered, if Congress is unable to come to terms to support the economy in both the short and medium term, then US GDP growth is likely to slow quickly back towards trend through 2021, before the losses of 2020's recession are won back. To this view, the downside risks from COVID-19 spread are material, but difficult to quantify precisely. This situation will quickly put the focus for economic policy squarely back on the US FOMC. Even without the uncertainty created by these recent developments, the FOMC was forecasting a decade of inflation disappointment to extend to almost 15 years by end 2023. Seeing as they are now targeting average inflation of 2% over time, this is not an acceptable outcome. And now, even this unacceptable forecast has downside risks attached. In coming months, we therefore expect the FOMC will need to act to support the economy. This has clear implications for FX markets, which is where we will turn next week. We'll see you then.